Shares of Lockheed Martin took a hit today, dropping 11.80% even though they reported earnings that beat expectations. But investors weren't happy with the company's revenues and not the bottom line. Lockheed Martin's third-quarter earnings dropped 65% year-over-year to $2.21 per share, which comfortably exceeded analysts' consensus estimate of $1.97 per share. The shortfall was due to the company taking a $1.7 billion non-cash pension settlement charge. Without that charge, based on GAAP, it would have earned nearly $7 a share and grown its earnings by about 11%. Analysts had expected Lockheed Martin to report $17.1 billion in sales for the quarter, but it only generated $16 billion. The issue was not with earnings, the issue was the downward revision in sales estimates. Lockheed saw a decline in sales of all four of its main business segments, with space revenue falling by 5% for example. On the plus side, operating profits increased in all four segments. Lockheed is having more trouble than it thought. The company warned that it will only be able to make a profit if they earn $67 billion this year, which may not be a very high number compared to the growth from 2020. But its guidance before was for revenue of $67.3 billion to $68.7 billion, which is slower growth than investors had hoped for. Meanwhile, earnings are expected to fall by 8% this year. Although this is lower than the previous projection of $22.25, it's still better than it could have been. Profit from operations is not as high as management had hoped for and will present around $8.3 billion. Lockheed's report points to the negative impact of the reduced revenue growth on their business. But management says there are things they can still do to prevent even further decreases. We are adjusting our capital allocation strategy with two major objectives, one of which is that, over the short, mid and long term, we will strive to maximize cash flow per share dynamically, including by buying back shares. If you're a Lockheed Martin shareholder, you'll be glad to hear that the company's shares just got a whole lot cheaper to repurchase. Facebook shares dropped 3.9%, following the release of their Q3 numbers. Facebook's revenue jumped 33% year-over-year to $29 billion, propelled by ongoing growth in the company's core digital ad business. Those gains, however, fell short of Wall Street expectations for revenue of nearly $29.6 billion. Facebook has a monthly active user base of 2.91 billion and an average revenue per user of $10, but it did not meet expectations for two other key metrics. First, the company's revenues only reached respectively $2.98 billion and an average of $10.17, which fell short of consensus estimates of $2.93 billion and $10.15. It's true that Facebook stock has been shaky lately, but the company remains profitable. In fact, its operating income jumped a whopping 30% to a whooping $10.4 billion and its earnings per share of $3.22 also outperformed estimates by coming in at $3.19. Investors are worried that Facebook will struggle with Apple's new privacy rules. These changes have prevented them from targeting ads to their customers. Facebook's guidance was in good spirits, and they're still optimistic in spite of these challenges. Their projections for 4Q revenue were $31.5 billion to $34 billion, while analysts had estimated an amount of $34.8 billion. Facebook has been under the microscope lately after the company's been criticized for failing to address a number of problems, including misinformation, hate speech and other forms of troubling behavior on their websites. This might be a cause for concern to some, but this is also reflected in the company's share price. Currently, it's a less than a 20 times multiplier from its projected earnings from 2022. It might not seem as drastic as other companies though. Facebook believes that their stock is worth investing in, because they just increased their share repurchase program by $50 billion. Thank you for following.